Good morning, good morning, good morning, everyone. It is Wednesday, October 26th. Can you believe that the month is almost gone? I am so excited for today's show. Today, we're going to be talking about, can we survive 10% mortgage interest rates? Can we? What are your feeling about it? What do you think? What's going on with you? How do you think all of this is going to go down? I need some information in the chat. Liza says, Grand Rising, beautiful people. All right. Okay. So let's see. My niece is trying to contact me, and I'm going to tell her, yes, I do. Yes, on both. But I am live on Facebook and YouTube now. So let me get here. All right, there we go. There. All right. So I'm back, folks. My niece reached out to me. I had to text her back, so we wouldn't get into a whole long conversation, so she can know that I've got the information for her. So we're going to help her out in whatever she's looking for. So, folks, listen. Let me get back here. Wherever. Let's see what's going on. Oh my goodness. No. Apple's. Okay. Dr. Apples says that sucks. I want to sell my house in about 2.5 years. So can I move into a bigger house? Will the rates be like that 10% then? It could be. It very well could be. All right. So, all right. So listen, if we can, if you want to, if it is possible for you to do well at 10%, would you want to know how? That's the thing, folks. If it's possible, would you want to know how? All right, to do well even at 10%. What can we do to manage those loans? Oh, I've got Miss Betty in here. How you doing, Miss Betty? All right, I see you there. And I see Tanika. I see Mike. All right, Mike looks like he's fairly new. I got Sharp. I got Marie. I got Dylan, Wanda, Apple, Stacy, Jeffrey, Liza. All right, and Miss Donna. How are you doing, Miss Donna?
I'm doing good, Ice. Thanks for asking.
All right. So you won't have to worry about this in Canada. All right, because I mean the interest rates for some reason just are forever around 2 or 3% or even less.
Absolutely not.
No? What's going on?
Absolutely not. We are on the rise.
Talk to us about it.
Oh yes, as soon as I'd say my grandmother would say, as soon as the Americans catch a cold, the Canadians are blowing their nose. So, so I'll tell you, it's not. It is on the rise, just the same.
All right, folks, listen, if you want to see some of these numbers that we're going to be putting up on the screen, you want to know how to survive this. You want to know what to do about it. And we're going to be talking. I'm going to pin my link to the top. All right, ice10k.com. And if you want to see what's going on here, you want to be able to watch us live on Facebook, YouTube, Twitter, and LinkedIn. We're out there right now live for you guys, and we're going to be putting up some numbers. So Donna, what are the interest rates like right now in Canada? Can you tell us? And if you're talking, you're on mute. All right. Donna is busy right now, folks. Listen, anybody else have anything to say about this? Raise your hand, come to the stage, and we'll talk about it. Let me see here. Apples, do you want to talk about that? You want to come up to the stage and share, or are you at work or on your way to work? I don't know. So let me know. I would love it if I could get more people on the stage to ask their questions so that they can, not only can other people learn, but we can learn also. So click the link above. And if you have a separate device, your, let's say, tablet, your laptop computer, you can go to one of the four social media platforms that I just mentioned, and you can watch us live, and you can see the numbers as we put them up. All right. So, Miss Liza, are you able to talk to us this morning? And if you are, please raise your hand. We'll bring you up on stage so that you can talk to us about interest rates in your area. Are there any other mortgage professionals in the room right now that could talk to us about interest rates in your area? All right. In the meantime, everybody who's in here, okay, Apple says can't talk right now. That's okay. So listen, here wherever you are, all right, check in from wherever you are. Please put it in the chat and put it in. If you're watching us live, go ahead and put it in the comments. Where are you watching us from, or where are you listening to us from? If you're on Clubhouse. So where are you from today? All right. All right. Liza says,
I'm here. My hand was wet. That button would not come off. Not come off.
oh, no, not when your hand's wet, Donna.
I'm telling you, I didn't realize that. Okay, so right now, we are as of October 25th. We're about 5.24 in terms of our interest rate.
Wow. Okay, so we have somebody here. Sharp is Canadian, and listen, if you guys have been around 1 and 2% forever, are Canadians losing their minds now? We're at 5.25. What's going on?
5 point, yeah. Well, we are. Listen, the properties are expensive here. I can tell you.
That's true. That's true. I heard about that.
Very expensive here. So, I mean, it is what it is. And I mean, you know what, Don, the good thing about it for me?
What's that?
I don't anymore think about interest costs. It's like, no, I'm being honest to you. Being here before,
yes,
that would be something foremost. And it's like, oh, it's going to go up. And then, there's a heart palpitation and you can't buy. And, as I said, everything here is $1 million, right? I mean, in the GTA here, I'm out on the outskirts and everything is $1 million.
yes.
Yeah. But now, getting into, as you said earlier, coming into the streets of Clubhouse, learning what the P.I.L.L method is and how you're able to save interest cost. And here, what is good? The higher, once you can afford to pay, it's better than being low. And understanding that when you're refining for a lower rate, but at the same time, your principal increase. Now, I don't worry about those things. They're behind me. It's like going to the gas station and know that, hey, it is high. I'm going to have to buy it. So for me, buying the property, whether it's 10% I'm going to pay or it's going to be 5.99, I am good because it's not about the interest rate. It's all about the interest cost.
It's not about the rate. It's about the cost. So folks, think of it this way. All right. Gas prices being what they are. All right. Gas prices are like 7%. $7, $6 and $7 in California right now. All right. And the gas prices are expensive all over. But what if you can get a discount card cutting your gas bill, your gasoline, every time you swipe at the pump, you can get 75% off. Does it matter how much the prices are if you can get a discount? That's what we're talking about today. It doesn't matter what the interest rate is. What matters is what you end up paying. What is it that you're going to end up paying? And you have control over that. You don't have control over what the Fed does. You don't have control over what your mortgage company does. You don't have control over what's going on out there. You don't have control over the fear that people are feeling, and then they're broadcasting that to you. You don't have control over that. You don't have other people's fears, other what people do with their business. It doesn't matter what they expect you to pay. What matters is what you're actually paying. Can you cut the interest cost by 50 to 75%? That's what we're talking about today. So I need as many people in here as possible to talk about it this morning. Dawn, how are you doing this morning?
Hey, I'm amazing. How are you?
I am doing well this morning. Listen, we're going to have people, we're going to have you two introduce yourselves because I think people are wanting to dive right into this right away. Now, folks, if you want to know more about this, all right, I need you once, if before you can get away, all right, and you're listening to the replays or whatever, you need to know how you can find out more about what we do here at the P.I.L. Method. So click on the link above and find our information there. All right. And if you want to know the month, day, and year you could be debt free, how you can handle double digit interest rates. All right. Go ahead and fill out your information there by clicking on getting a savings and earnings report. Getting a savings and earnings report. Once you do that, and at your current situation, you can learn how to handle any financial situation that comes from your bank forever. Okay. What we want to do, folks. All right, here. Let you hear from our moderators. Let them introduce themselves, and then I'll introduce myself and what we do here at the P.I.L. Method so that you can understand where we're coming from. Miss Dawn, will you please introduce yourself and tell the people who you are and what you do, please?
Sure. Good morning. My name is Dawn Robinson, the Money PhD, single teenage mom of twins, turned millionaire by age 44. But that was not without making many money mistakes. I thought I was doing well. Thought I had done all the right things. 8 months of savings, 401k, 3 rental properties by 31, until I got a bad boss and couldn't afford to quit. And when I finally looked at my money, I call that when I got financially naked with myself. I was $140,000 in debt, paid it off in 17 months. And now on this journey to help other professional women over 40, we typically know how to make the money, but we do not know how to keep it, and are secretly struggling to figure out this money thing, how to save, pay off debt so we can invest and live the life that we want. So here's the thing for me is I help women who have not saved at least $2,000 for every year they work full time and are secretly struggling to get all this stuff started. I believe that financial freedom, that you're not in financial freedom and that you're not financially free until work becomes optional. So this is Dawn, and I'm done speaking.
Thank you very much, Dawn. Miss Donna from Canada, tell us who you are and what you do, please.
Hi, everyone. Good morning. I'm Donna, located in Canada. I'm a commercial loan broker.
Uh-oh, the Matrix has you, Donna. The Matrix has you.
Living spaces. They're calling me now for report.
Oh,
So that's living, independent living, owner operator, commercial loan broker, business purpose loan. I can lend you all for you, whatever your lending needs are, fix and flip, whatever it is. You can check my bio and for whatever else you need. Thank you.
all right, folks, listen, we're going to go ahead and get things kicked off. My name is Don Daniel, founder of P.I.L. Method International, a better way to eliminate debt. And for the last 16 years, that's what we've been doing, is helping people eliminate their debt cheaper and faster. What we do is we help people to identify how much interest they're actually paying and what you could do about it. For 16 years, we've been teaching people how to read an amortization schedule, find out how the bank is making their money, learn the rules to the game, and now you can cut your interest cost by 75% using technology and education. There is no better technology or education on the planet that helps you to understand and beat the bank at their own game using technology, using all of this stuff. You can cut your interest cost by 75%. What does that mean? Meaning you can actually pay off all of your debt in an average of 7 to 9 years without ever refinancing your loan. It's not necessary. You don't really have to change your budget. We're going to use the same budget, the same amount of money you're already making. You don't need more money to get out of debt. You just need to pay less interest. We're going to show you how. And you don't have to sacrifice lifestyle. What? You mean I don't have to stay home? I don't have to, you can't go anywhere. You can't do anything. I mean, you got to take all of your money. You got to sell pizza at night. You've got to cut up your credit cards. You got to drive a 30-year-old car. You got to do all of these things, live like a pauper so that you can take all of that money and throw it at the debt. And then once the debt is gone, you can start living. No. I don't believe in that. The problem with the debt is the amount of interest we are paying, and you have control over how much interest you pay. So can we survive 10% interest rates? The answer is yes. So if you can afford the payment, folks, if you can afford the payment, see, let's break this thing down to where we need to break it down to. All right, follow me here. What does it cost to live in a house? What does it cost to put a roof over your head? Find out what it costs, whether you're renting or whether you are purchasing a home, whether you're renting or buying. Okay. I need you to understand this. If you're renting from a landlord and you're paying that mortgage. You're paying the landlord's mortgage. Okay. If you are buying a home and you have a mortgage, now you're renting the money to buy your home. You're still renting. Now, once you figure out, because interest is nothing more than rent on your money, folks. All right. So if once you figure this out, how much does it cost to put a roof over your head, whether you're renting your house or apartment or you're renting the money? Now we have to figure out how much does it cost. And then you compare the costs, and then you make a decision based on numbers. Okay. Good morning, Jeremiah, and he's watching us here from YouTube. All right. So listen, focus on the numbers. Focus on the actual numbers, what it costs to live, not react to words like interest rates. If you react to the words without doing the math, that is going to be a problem for you. And everybody is reacting to the words 7% interest rate. And they're just going haywire over these things. Okay. Because no one is actually sitting down and showing you the numbers. So if you have an interest rate of 7% right now, it could go to 10%. Then figure out how much you would be paying and compare that to the rent in your area. For the house that you can afford, for the rent you can afford, for the mortgage you can afford, compare the two. And if they're similar, now you're making a decision that's not based in feeling, it's based in fact. All right. So, Dawn, what do you think about that? Can you talk to us this morning?
Hold on. I'm gonna take you off on speaker. So yeah, I think that the main thing there is when it comes to, you made a couple of great points. If you can afford the payment, and then again, I always think that you should pay the mortgage off. And I don't think that we talk about those things. And renting, there's still some consequences to that. I was just talking to my sister that you can't control your rent, right? So a mortgage is basically, for me, rent control and a forced piggy bank.
Uh-oh. Listen, Dawn. Okay, you're talking about rent control and a forced piggy bank. I think I know where you're going with that, but can you explain it a little bit more for us?
Yeah, so what I mean by rent control is that you can't control the escalation in the rent because you don't own the property. So you're at the liberty of what that homeowner wants to do. So if they want to go from 1,200 to 1,500 when your lease renews, they can. If they want to go from 12 to 18, they can. They can just do it. I will not renew in most states that don't have those rent controls there. And when I say a forced piggy bank on a home ownership, is because you still got the total cost of ownership. You have maintenance, you have roof repair, you have all of these things that go with home ownership. Now the equity is what I call the forced piggy bank, except you do, in order to access that equity, you have to borrow against it. So it's still never really yours. You just get to, open the piggy bank and then you got to put it back in. So this is Dawn. I'm done speaking.
All right, folks. Thank you so very much, Dawn. Credit Goddess, you're in the room. Thank you so much for coming in here today to talk about, can we survive 10% mortgage interest rates? How are you doing this morning, Credit Goddess?
Great, Don. How are you?
I'm doing well. Would you like to introduce yourself, please?
Absolutely. Hey, my name is Rosalora Lewis. I'm also known as Credit Goddess. I am all things credit. I'm a credit score improvement strategist. And what I mean by improvement is only because I don't only just repair, but through education, I help my clients optimize and improve their credit so that way they can be in the best position to qualify for any type of funding, financing that is out there. I'm also a business credit coach. I help entrepreneurs, business owners establish business credit to separate themselves from their personal on their way up to corporate credit. And I'm also NAV business loan broker. If you guys are looking for funding, I'm your girl, and also an educator in the credit space. So yeah, I'm all things credit.
All right. Thank you so very much for that. So, folks, let me go ahead and get everything set up here in my studio. We're going to put things on the screen for you so that we can go ahead and let me see. I've added that. Oh, I got to share the screen now. There we go. All right. It's awesome. We're getting set up here. We're getting set up. So, folks, here's what I'm talking about today. All right. Here's what I'm talking about today. Know your numbers. Know your numbers. If you want help, we're here to help you. All right. I'm when it comes to interest cancellation, I am the expert. All right. And I'm not bragging. What I'm trying to tell you is I have the only book on the subject that you can find on Amazon. So understanding how an amortization schedule works is vital. And we're giving the information away for free on this app. Okay. So if you don't know how to play the game, when people are talking about who are so-called experts out there, and you don't know enough to challenge them, I was talking to a guy today. He's been in mortgages for 20 years. And here's what they're telling you right now. Okay. Marry the house, but date the rate. Marry the house, but date the rate. Folks, what does anybody know what that means? Marry the house, but date the rate. All right. Come up to the stage if you have a question or comment on this, especially if you are a real estate investor, if you're a realtor, if you are a mortgage loan officer or MLO, mortgage loan originator, come up to the stage. Let's talk about it this morning. But I want to know, does anybody know what that means to marry the house, but date the rate? Anybody got anything to say about that? All right. Well, then I'll tell you. All right. So they'll say, go ahead. If you can afford it, even at 7%, get into the property, whether you're a real estate investor or you're a home buyer. But the interest rates won't always be at 7%. When and if the interest rates fall, you can refinance out of that high interest rate into a low interest rate. I've heard that said so many times. But you know what I don't hear? What I don't hear is somebody explaining what are the benefits and drawbacks of having the 7% rate. And then what are the benefits and the drawbacks of refinancing to maybe a 5% rate? It is not an automatic deal. It's not an automatic assumption that you're going to be better off at 5% just because it's a lower interest rate. Can I tell you a little story here that really matters? And then we'll get into some numbers. Okay. Here's what they're comparing. When a mortgage professional or a real estate agent or anybody in the area, here's what they're doing. They're comparing two 30-year loans. Okay. They're comparing two 30-year loans, not just 30-year amortization, how the bank figures out how much you're going to pay. That's the amortization schedule, but keeping the loan for the entire 30 years. Here's what they're doing. If you have an interest rate of 7% and you keep the loan for the entire 30 years, and you compare that with somebody who has the same amount of money, they're borrowing the same amount of money at 5%, and they keep the loan for the entire 30 years, then obviously the 5% rate is better. Anybody disagree with that? But what if you're paying the loan off early and cheaper? What if you don't want to keep a 30-year mortgage? What if you want to cut your interest cost by 75% and now pay off the house in, let's say, 7 years? So do those numbers still apply? Listen, can I get some input from the stage? If I keep the house for less than 30 years, do those numbers apply here? Anybody? I'm talking to myself. All right, that's okay. I'll talk to myself. Listen, so what we're saying here is you can, if you're going to pay less interest, which loan is going to put you in the best position to pay the loan off cheaper and faster? Let me take a look at our chat here. Oh, okay. So we got somebody coming in from, let's see, we got people here from Georgia. We got people here from Canada, from Maryland. Oh, from Dallas, Texas. I'm going to be in Houston on the 5th and the 6th. I'll probably be there from the 5th through the 7th. I'll be in Houston. We have somebody from Lancaster, Pennsylvania. I know some folks there. All right. So listen, folks, if you're new to the room, check in. Tell us where you're from. All right. So keep this in mind. No one really wants to keep a loan for 30 years and pay all of that interest. Let's put something on the screen. Let's go over that right now so we can take a look at putting a mortgage on the screen. So let's say, let's make it $450 this time. Okay. I got a $450,000 loan. Okay. Let's go at 7%. And let's take a look at this. Now, here's our payment. $2,993.86. That's the principal and interest payment. Okay. We've got some stuff coming in here on I've got to talk to my engineer. We have some stuff that somebody is posting in the comment section. Can we delete that stuff? I'd appreciate it. Okay. So, all right. Fantastic. We got them blocked. All righty. All right. So here we go, folks. We have $450,000 at 7%. Let's take a look at how much interest the bank wants us to pay. $450,000. Now, if we keep this loan for 30 years, all right, here is what the the experts, the mortgage experts are telling us. If you keep that loan for 30 years, you're going to pay $627,000 in interest. Is anybody interested in paying $627,000 interest on a $450,000 loan? All right. Credit goddess. What you got your emojis going. What are you talking about?
I'm not paying all that.
No, nobody wants to
No.
pay that. So
No.
all right. So let's go ahead. Tiffany says no. All right. All right. And somebody who, Donna, are you with us right now?
I am right here. Absolutely not.
Will you monitor the chat for us and say,
I will.
Thank you. And see what the people are saying there about this. So I'm going to put in the same loan. I'm putting in the same loan, $450,000. All right. $450,000. There we go. 450. And we're going to put it in at 5%. Okay. 5%. Here's what the experts are telling us. Now they're comparing if I have a 5% loan, all right, I got 450,000, but if I keep it for 30 years, I'm still going to pay $419,652. I don't want to pay that either. But it is less than the 627,000. But folks, those numbers only apply if you keep the loan for 30 years. And we're not required to keep it for 30 years. We're showing you how to pay it off in 7. So what would help us to be in a better position to pay the loan off cheaper and faster? Now, here's the next thing. I am not required to pay all this interest. So write these two things down. Number 1, control the principal payment and you control the loan. That's number 1. Control the interest payment and you control the loan. Number 2, interest payments you skip don't matter. Interest payments you skip don't matter. Let's take a look at the higher interest rate now, because that's where we are. All right. So let's take a look at this. We're paying $2,993.86. That's the principal and interest. And I recommend very highly that if your loan allows it, pay the taxes and insurance on your own. Don't escrow that money. The bank is saying, or your mortgage company is saying, we're going to do you a favor and pay the taxes and insurance for you. We're going to add it to the mortgage payment and it's going to make it easy. Here's what's happening. Somebody's opening up for you for your benefit. And I'm doing air quotes if you can't see it. Okay. For your benefit, they're opening up a savings account for you. And when you make your mortgage payment, and you have your taxes and insurance added to your mortgage payment, then they're taking that money and putting it in that savings account for you, which pays you no interest. So if they're putting it in a savings account for you, somebody is benefiting from you putting money in a savings account that you're getting no interest on. Are you hearing me right now? Okay. Somebody's making money off your money that you're putting in a bank account and you're keeping it there all year long so that they can then take that money and then pay your taxes and insurance. Do you think for 1 minute that money is sitting there all year and someone is not benefiting from it? They're not making interest on your money while you're storing it in there, and they're doing you a favor by paying your taxes and insurance for you? Folks, if you want to do that, open up a savings account on your own. And every time you pay your mortgage, put the same amount of money in your own savings account. You could do that for yourself. Credit goddess, could you do that? Is that possible?
Yes.
What do you think, Donna? Could you open up a savings account on your own if your mortgage company will allow, if the rules will allow it, you could put that money away yourself?
Yep.
Come on, folks. What we're trying to do is put you in the best financial position possible to take advantage of these things. So now I'm looking at this loan. Let me take a look at the payment structure, how this loan is structured. Okay, so now we have out of that payment, $368.86 goes to principal, $2,625 goes to interest. Oh, and Sinister says that's scandalous. He's watching us from YouTube right now, and he says, yeah, taking that money, putting it away, and they benefiting from it, calling it a benefit to us to pay the taxes and insurance when we could do that ourselves. Listen, folks, yeah, we've got to start thinking about our money. This money is something we ought to think about. What the banking system has done is put things on autopilot so that we don't have to think about it. And when we don't think about it, guess who benefits from a system that has been put on autopilot, made it seem so simple that we don't think about it, while somebody else is getting rich off our money because we stopped thinking about it. The purpose of this show is to make sure you start thinking about your money. I got 7 shares in here, and I appreciate it so very much. Okay. And Tiffany says, jumped over here from Clubhouse, needed to see this. Okay, Tiffany, that's all right. All right. So listen, that's quite all right. I'm glad you did. All right. So now watch this, folks. I need you to watch this because now we're learning how to be in control of our money because we're thinking about it. This is at 7%. Now, remember what I said, control the interest payments, and you control if you control the principal payments, you control the loan. And interest payments I skip don't matter. So I have $368.86 going to principal. Look at this interest cost. $2,625 goes to interest. How do you guys feel about that? I need you to put that in the chat. I need to know how you feel about a situation where I have a payment that I can afford. It is similar to what I would be paying in rent. Okay, I'm making that payment, but out of that payment, only $368 of my payment is actually paying off my house, and the bank is saying, "Thank you very much for your $368 in payment. We're going to charge you $2,625 to process that payment." What? You're going to charge me $2,625 interest? You're going to charge me that as rent on the money that I borrowed, $2,625, in order for me to pay my house down by $368.86. Folks, what do you think about that? I need you to put it in the chat. All right? What do you think about the fact that they're charging us that kind of money? All right. If you can't come to the stage, that's quite all right. But at least let's put it in the chat and tell me what you're thinking. Put it and if you're watching us online, put it in the comments. Okay. Sinister says, how is that legal? Well, it is legal. It is very legal. Tiffany says, wow, I'm in the wrong business. Okay. That's what she says. All right. From watching us here on YouTube. Now, so here's what we're doing. Now, the next month, it gets better. Dawn. What we're doing here is that the next month, $371 and a penny goes to principal. And the interest cost drops all the way down to $2,622.85 instead of $2,625. Does that make you all feel any better? That it dropped not even $3. Okay, less $2 and some change. You're paying $2 and some change less next month. Now that's how a mortgage works. Every month you pay a little more principal and a little less interest, but your payment stays the same. So if your interest drops by $2 the next month, then they put that $2 on the principal next month. That's how it works. All right. Sinister says, no, that doesn't make me feel better. All right. Now let's learn how to read this thing. You're paying rent on how much money you owe. And because the bank has chosen a system that makes them a whole lot of money, I need to show you how much money they're making by percentages. So I'm going to put it on the screen right now. Okay. We're getting this background so we can learn how to manage a 10% loan. Okay. But you got to have this background first. So if my mortgage payment is $2,993.86. We got that on the screen. And I'm going to put the first interest payment in here of $2,625. And now we're going to divide it by our mortgage payment. All right. So we're going to divide that by 2,993.86. And that equals 87%, 0.876. Now, because if we go out three places, because the 6 is 5 or greater, then we round up the next number. So 88%. 88% of your payment is going to interest. What does that mean? If you take a look at every housing dollar, which would be $2,993.86, every housing dollar, and you do the math, that means out of every dollar, 88 cents out of that dollar goes to interest. Only 12 cents out of the dollar goes to your mortgage. Anybody ever look at it that way? Do you want to be in a position where 88%, 88 cents out of every dollar you're putting towards your mortgage goes to interest, and only 12 cents out of every dollar goes to pay down your house? That is what's going on. And because the bank has chosen that system, do you realize we can turn that system on their heads, and we can use the system to benefit us? Anybody want to know how we can take this system the way it is now and turn it around so that we get the 88 cents and the bank gets the 12 cents? Come on. Anybody wants to know? Listen, if you want to know how that works, I need to see it in the chat. Say, yes, listen, I need you to start this chat. Yes, we can. Because listen, we're going to do better with this thing. Yes, we can. All right. If you want to know how we can do better with this thing, put a number 9 in the chat, or yes, we can. Whatever you want to put in there, put a number 9, put a yes, we can in the chat, because we can do better than this. Tiffany says, I got to know, in all caps, exclamation point. Sinister says 12 cents. Oh my goodness. Miss Donna, what are they saying in the chat?
Well, what we are having is yes, we can. 999s, 999s, yes, 999s, yes, we can. 99s.
Okay. Well, listen, I'm excited to tell you, because once you look at it this way, folks, you cannot unsee this. You can't unsee the fact that the system we're in is doing this to us, giving us a payment we can afford. And the reason why we got into home buying is because before, if we were paying $3,000 in rent, all the money goes to someone else. But when we buy a house, in this situation, nearly all the money goes to someone else. Not all of it, but nearly all. 12 cents goes to us, 88 cents goes to someone else. Oh my gosh. All right. Oh, what can we do about that? Now, here's so what were the first two things we wrote down? All right. First two things: control the principal payment, you control the loan. Interest payment, and number 2, interest payments I skip don't matter. All right. Interest payments I skip don't matter. The next thing we want to do is find out what are the rules to the game. Learn the rules to the game. And here's the next rule. Okay. If we do things right, we can save at the same rate they're charging us. We can save at the same rate they're charging us if we know how to read this. Watch this. So let's say we're making our payment, our regular payment here in January. Okay, make our first payment in January. Okay, payment is made in January. We don't owe anything else till February. We have $450,000. We've just subtracted $368.86 from the $450,000 that we owe. And we have a principal balance of $449,631.14. And the bank uses this number to figure out how much interest we pay on the next line. Now, we did a little bit of math to figure out how much of that payment goes to us, but we didn't do the math on how the bank figures out how much interest to charge us. We haven't done that, Credit Goddess. And she's on the phone right now, but she would take us through this. So I'm going to show you how the bank makes their money. All right. Now, we're going to go over that right now and see how we can do this. All right. So I'm going to put a calculator back on the screen. If you're new to the room and you want to see what's going on, please go to, we're live right now on YouTube, Facebook, Twitter, and LinkedIn. If you click the link at the top, you can get all of our links there where it says watch us live, or you can go straight to those platforms and search P.I.L.L method on a separate device. You can listen to us on Clubhouse and you can watch us live on a separate device if you choose to. But if you want to see this, you can only see it on Clubhouse. I'm sorry, you can only see it on YouTube, Facebook, Twitter, or LinkedIn. Now, let's take a look at this. Our interest rate on this loan, folks, is 7%. 7% interest on this loan. So how does the bank do this? Okay, how are they charging us? Here's how they charge us. We're going to take that 7% and we're going to put it in our calculator as 0.07. Okay, 0.07. That's how you put it, 7% into a calculator. Then we take that number and we're going to divide that number by 12. Divide it by 12. Okay. Now here's what we get out of that. 0.0058 and then a bunch of threes. You got that? Now, the bank takes that number, 1/12 of the interest rate, and multiplies it by the unpaid balance. So we're going to multiply this number by this number, the 449,631.14. So, okay, so we're going to take that number and we're going to multiply it by 449,631.14. And that equals 2622,848. Now remember, when this third number is large as 5 or more, we have to round up the next number to the left. So it's 85, 2,622.85. If we take a look at our mortgage here, look at that, 2,622.85 is the exact same number. That's how they do it. They take 1/12 of the interest rate and multiply it by the unpaid balance 360 times. That's how they make their money. And I'm okay with that. Do you know why I'm okay with that? Because we can use the same math to our benefit. Are you ready to learn it now? Here we go. All right. So because they're using that system, remember, they can only charge us that kind of interest based on the principal balance each month. So what if the principal balance is different from what they're expecting. Oh, watch this. So now I make my mortgage payment in January. All right. And now my next mortgage payment I won't have to pay anything until February. So I can actually see on the schedule what February's principal payment is. I'm in January, but if I look at the schedule, I can see that my principal payment for February is $371 and a penny. Okay. Now, this is not how my program works. Right now, I'm just teaching how the bank makes their money. That's it. I'm just teaching how the bank makes their money so that we can learn what to do about it. Here's my question to you. If I know I have to pay that next month, do I have to wait till next month to pay the $371.01? If I have that money in the bank, if I have some extra cash, do I have to wait till February to give the bank $371 and a penny? The answer is no, I don't. I can give it to them in January, and then they have to apply that to principal because that's the rules of the loan. It's written in your loan. If you give this money to them early, they cannot charge you interest. What? Watch. So now I give this to them early. They have to subtract that from what I owe. Do you realize if they subtract that, I'm paid down to line 2 in January. I'm paid down to line 2 in January, and they need this number on line 1 to figure out how much interest I would pay on line 2. But guess what? If I give them the money early, I am no longer on line 1 in January. I am now on line 2 in January. So now they can only figure the interest cost on this amount. And this is how the loan is set up. The loan is set up this way, that they charge us 1/12 of the interest rate on the unpaid balance monthly. Every month, 360 months, 360 times, okay? They want to charge us 1/12 of the interest rate. What if we can remove 1 month, and then that means they can't charge us a whole interest payment for that month because we removed it. How do we remove it? Here's how we remove it. I'm going to take the $371.01 and I'm going to pay it early. So I'm paid down to line 2 already, which means my next mortgage payment is based on this number, which gives us the interest cost on line 3. The principal balance on line 2 gives us the payment on line 3. So this is my new February payment. So what just happened? For $371 and a penny, I paid early. I removed 1 line from the amortization schedule. And the interest they would have charged me, $2,622.85, I never have to pay. So remember that total interest payment we were looking at of $627,000? I just reduced that amount by $2,622.85 that I don't have to pay, only because now I've learned how to read this amortization schedule. For $371, folks, $371. I just turned a 360 payment schedule into 359 payment schedule, and I just saved myself $2,622.85. Folks, if that's powerful, put a yes in the chat. If you like that information, put a yes in the chat right now. Donna, what are you seeing? Are they putting yes in the chat? Listen, do you think that's powerful information? Folks on the stage, you think that's powerful? If you're watching this online, go ahead, put a yes in the chat if you think that's powerful. Okay. Is there anybody else online or in a book anywhere else that's teaching you that? I'm telling you, this is powerful. This is powerful stuff. If you think this is powerful, wait till you hear this. All right. So now, what if we did this? What if we did this? I make my January payment, right? Because remember, the Facebook user says yes. Sinister says most definitely. Ryan Cloud says yes. Watch this, folks. If you're watching us online, we got 11 people online here. We have, how many people do we have on Clubhouse? We got 36 people. Listen, if you're online, share this to your people because they need to see this too. Share it right now. If you're online, if you're in Clubhouse, share it in Clubhouse. Okay, share it out. Share it out. We got 11 shares in here. Let's get some more shares. Let's build up so people can see this. Now, watch this. We are paying January's payment. And because we learned this, what if we did this? We have some money in the bank. And that money is making us 1/10 of 1%. What if we did this? Pay the bank extra. We make our mortgage payment in January. And we give the bank $371 and a penny extra. Then the principal payment on line 3, $373. And then the principal payment on line 4, the $375.35. Let's do all of that in 1 month. Okay. So we're going to add this up. Okay. 371, all right, 0.01 plus 373, okay, 0.18 plus 375.35, okay, 375.35 equals $1,119.54. So folks, somebody with this mortgage, if they had, I'm just saying if they had it, they may not have it, but if they did, if they had an extra $1,119.54 sitting in their savings account, if they applied it to this loan in the first month, do you realize they knock off the interest payments on line 2, line 3, and line 4, a little over $1,100, saves them over $7,000 in interest, $7,868. $1,100 invested in your mortgage saves you $7,886.53. What? Listen, if I invest that in the stock market right now, I'm not going to get that kind of return right now. Am I, folks? Am I going to get that kind of return? So if you know how to read this thing, does it make sense for us to learn how to read it? So folks, what I've just showed you, if you were in the 7th grade, some of you have 7th graders. If I showed somebody in the 7th grade this, could they understand it? If you believe a 7th grader could understand this, put a 7 in the chat. Put a 7 in the chat right now. Put a 7 in the chat right now if you believe a 7th grader could understand what I just explained to you and put on the screen. All right, Derek says 7. Giovanni says 7. All right. Syed says 7. All right. So listen, if a 7th grader can understand it, if a 7th grader can understand it, and you're learning it right now, why aren't we teaching this in 7th grade? Why aren't we teaching it in 7th grade? Huh? If a 7th grade, if you knew this in the 7th grade, that when you get your mortgage, you don't have to keep it for 30 years. You can pay it off in 7 by understanding how this is going. Listen, Derek Risen says, you are crystal clear. Crystal clear. Boy, oh boy.
And Miss Princewell in the chat said, problem is that rising interest rate and inflation, people have lower disposal income and may not have the extra to pay down the mortgage.
Okay, that is a good thing to see. Listen, let me tell you something. I've been doing this 16 years. 16 years. I've never run into a person yet that can pay all of their bills, all right, every single month. They can pay all of their bills every single month, and they're left with $0 at the end of the month. I've never seen it happen. I've never seen it happen when you have $0 left. Okay? There's going to be some money left. The thing is, we don't think that the little bit of money that we have matters. Can I show you how a little bit of money in this mortgage actually matters? If you want to see that, if you want to see how a little bit of money matters, put a yes in the chat. Come on. Can I listen? Because that is a very good point that somebody brings up. What if they don't have extra money? But I'm telling you, if you can pay your bills every month, okay, you should not be in this mortgage if you can't pay your bills every month. That's number one. So if you can pay your bills every month, you have some money left over. What can we do with a little bit of money? Tiffany says, show me, please. All right. The folks are saying this is life-changing. Listen, folks, if you're not sharing this with your folks, something is wrong. Something is wrong if you're not sharing this. So let me show you something here. All right. Listen, I'm going to get my calculator on the screen. Okay. Got my calculator on the screen, and I'm going to put in here the interest payment from line 2. All right. And Miss Donna, keep an eye out. And Credit Goddess, keep an eye out on people who have raised their hands and they want to come to the stage. If you want to come to the stage and talk about this and learn more, listen, if you come to the stage, I will do, listen, you bring me something and I'll do something private with you right here so that you can learn something that you wouldn't have learned if you hadn't asked the question. So if you have a question and you want to talk about it, come to the stage, raise your hand and we'll bring you up. Watch this, folks. I got a calculator on the screen and if you're watching me, I got my phone in my hand. Okay. So I'm going to put, here's the number I'm going to put in. All right. Okay. Well, something happened. All right. All right. So here's what we're doing, folks. All right. So I'm looking at this, and we're going to put in 2,000. We're going to put in $2,622.85. Okay. So what we just learned, if I prepay the $3,071 and a penny, if I prepay that, I don't have to pay the $2,622.85. And Donna's on the phone right now. So somebody said, what if I don't have that money? What if I don't have the money? All right. So let me put in my calculator. I'm going to put in, okay, 371.01. Okay. I'm going to put this in here, the 371.01, because if I prepay that, I don't have to pay the $2,600. All right. Somebody says, well, what if I don't have all that money? So I'm going to divide my 371 by 2. I only have half that money. Okay. So I'm going to divide it by 2. I have half that money. I only have $185.50. Okay. $185.50 to apply. I don't have the full 371. I only have 185. If I put $185 down, how much of this interest do I save? If I put half of it down, I save half the interest. So let me divide this by 2. Oh my goodness. I'm still going to save $1,311.43. Is it worth it if I only have $185.50? Is it still worth it to put that down and save $1,300 in interest I don't have to pay? Oh, what do y'all think of that? But guess what? What if I don't have $185? What if I only have half of that? Okay. So I'm going to divide mine by 2 again. Divide it by 2. Okay. I only have $92.75 now. $92.75. All right. So if I do that, I could only save half of the $1,300. So we're going to divide this by 2 again. Divide it by 2. And now for $92.75, I save $655.71. I don't have to pay the bank. Folks, you tell me If all I have is $92, is it worth it to put it on my mortgage if I know I can save $655? So here's what this means. Your $92 equates to $655 in money you don't have to give to the bank. What? Is that what this means? Folks, this is exactly what this means. Oh my goodness. You know what I'm getting ready to do, right? I don't have $92. I'm going to divide it by 2. I have $46.37. Folks, if at the end of the month, you've got to have at least $46, right? Okay. So $46. What if only out of the money that I have, all right, let's say I have more money than that, but I only want to spend $46 of it. I want to put the $46 on this mortgage. Now, if I put $46 on a $450,000 loan, it's not going to do very much to the principal at all. Okay. Because I'm looking in the wrong place. What the reason why we deal with mortgages the way we deal with them is because of all the interest that they're charging us. So we need to have a plan to pay less interest. Stop looking at the money we borrowed, because that's going to be that's what it is. But the interest we can manage, we can mitigate, we can cut, we can cancel, we can eliminate the interest. Watch this. So now I only have $46.37. So I'm going to divide mine by 2 again. Look at that. $46.37 saves me $327.86. Folks, if all I've got is $46, is it worth it to put that on the mortgage so that I can save $327.86 in interest? Is it worth it? All right. Listen, I got 13 shares. Listen, what's going on here? Miss Princewell says, so the extra money left is what you keep aside for emergency if you run into problems. It'll be hard to bail yourself out if all your extra money is paid to your mortgage. That's true. But don't pay it all to your mortgage. Build it up and then put some on your mortgage. Okay. So listen. So Miss Princewell, what you're saying is good. What you're saying is good. All right. Let's say you have $1,000 left over each month. Okay. In 5 months, how much money will you have in the bank of your extra money? You got 5 months. Okay. I've got $1,000. You'd have $5,000 left over, wouldn't you? Right. Could you take $46 out of your $5,000 and put it on the mortgage, or even $500 out of your $5,000, or even $1,000 out of your $5,000? Okay. If you take $1,000 out of this $5,000, $1,000, watch this, about $1,000 saves you about $7,868 here. $1,000 saves you about that much. And then if you're worried about your bank account suffering, you're taking $1,000 out this month and putting it on the mortgage to save $7,800 in interest. How long is it going to take you to put that $1,000 back? Exactly 1 month. Is it worth it to draw your savings down by $1,000 for 1 month, to put it on the mortgage and put it back next month? Or I could feel good about the fact that I'm looking at my $5,000 in the bank, because next month I'll have 6. So, Ms. Princewell, does that make sense? We're not saying take all of your money. What I'm showing here is what happens if you have some money and you put it towards the mortgage, because we're looking at the wrong thing. We're not looking at how much interest we can save. We're looking at how fast we bring down the principal. And if I only have $46, I'm not going to put it on my mortgage, because I only bring down the principal by so much. But if I have $46 that I can take out of the bank and put it on this mortgage and save $327, which would you rather do? Take the $46 out of your savings account and go to dinner, or save $327.86 with it. Ah, thank you. Listen, Miss Princewell, listen, by you asking the question, we other people get to hear the answer. So I appreciate you so very much for that. Oh my gosh, people, if Miss Princewell, if more people would do what you're doing, ask questions, more people could learn. So we thank you so very much. So now here's the next thing, folks. You don't want to put just any money down. You want to put the right amount in the right month on the right day of the month. Okay. So let me write this down myself. Okay. What are the things that we're writing down? Okay. So you want to take notes. The first is the control the principal payment. Okay. And then interest payments I skip don't matter. Okay. And then what we talked about is what was next? What was next? Okay. What was next? All right. We want to control the principal payment. Interest payments I skip don't matter. And then what was next? Can somebody remember what was next? Did anybody write it down? Okay, what was next? I'm looking back. I'm scrolling back through to see if somebody wrote it down. Okay. Does anybody remember what I said next? Okay.
Interest interest payment I miss. I don't worry about.
Yep. Okay. I got control principal payments. Skip.
Yep.
Skip interest payments. I skip don't matter.
Don't matter. No,
And there was a third one. Does anybody remember what I said third?
I don't remember that.
Okay. All right. Listen, it's going to come back. It's going to come back. We're going to put it on there now. But listen, here's the next thing. All right. Here's the next thing. Okay. You want to use whatever money you have. You want to control that. It's all about the interest saved and not paying down the principal. You want to pay off the loans cheap, not fast. Okay. You want to pay the loans off cheap, not fast. Because if I only have a little bit of money, all right, if I only have a little bit of money, I may not put it on here. I may want to spend it. I may want to do something else with it when I could put it over here. But if I do, we got some more stuff coming in on the chat on. So can we delete that as well and block these folks? I don't know why they want to come over here and try to get their stuff out there. I don't know why they're doing that. But anyway, cheap. So we want to do it cheap, not fast. So listen, I'm going to do this one more time, folks. I'm going to do this one more time so we can see what's going on. We're going to take that $46. We're going to divide that by 2. I got $23.19. $23.19. If I apply that to principal right here, divide this by 2. $23 really equates in this thing to $163.93 in interest I don't have to pay. Wow. $23.19. Okay. That's what we're talking about, folks. Understanding this. So now that we get this, watch this. I need you all to see this. Remember, we were contrasting. Now that we understand how to deal with a 7% loan, okay, if that payment is comparable to what we can afford in rent, does it make sense? To go ahead and get this loan at 7%? Does it make sense to get it at 7%? All right. Because I'm going to be paying that much in rent anyway, but this way I can control how much interest I pay. Oh my goodness. Does that make sense to you guys? Does that make sense? So why? Okay. So now we're going to do this. We're going to take a look at that 5% loan. Now remember, the first thing I said was interest payments, control the principal payment. I control the loan. And interest payments I skip don't matter. Interest payments I skip don't matter. Remember that. Okay. Now, we also want to put ourselves in a position to pay the loan off cheap, not fast. So which configuration is going to help us to pay the loan off cheap and not fast? All right. So remember, if I have a 5% loan, but if I have the 5% loan, the experts are telling us this is better. So if the interest rates drop, let's say to 5%, refinance out of that and get the 5% loan. Okay. So now let's take a look at this 5% loan. Look at the interest payments. They're smaller. Ooh, I'm feeling good. Look at my payment. Look at my payment on this thing. It's $2,415.70, as opposed to my payment is $2,625. So if I get the 5% loan, I'm looking at the short-term benefit of having a smaller payment, $2,415.70, as opposed to $2,625. That is a short-term benefit. But what is the long-term consequence of lowering my interest rate to 5% here? Okay. Remember, control the principal payment, you control the loan. My principal payment here is $368 for the first month, $371 for the second month. Okay. Remember this is the 7% loan. I want to show you one other thing, and then we're going to go to the 5% loan. Take a look at column 3 and column 4, cumulative principal and cumulative interest. If what you've heard so far was you thought that was powerful, wait till you see this. Wait till you see this. Watch this now. Watch this. Cumulative principal for 1 year. I'll pay this loan down by $4,571.12. It's going to cost me $31,000 in interest to do that. Are you seeing that? Folks, should it cost $31,355.20 to pay my loan down by $4,571.12? Should it cost $31,000? Oh my goodness. Listen, moderators, jump in at any time. You want to make a comment on this. All right. So watch this. If I have $4,571.12, what if I have that in the bank? What if I have a little extra money? Okay. What if I have it? I'm just showing you what could happen if you have it. If you have less than this, you can still make a huge dent in how much interest you are saving. And I'm telling you, you save more interest, you get out of debt faster. Pay more interest, you stay in debt longer. Okay, you need to write that down. Okay, pay more interest, stay in debt longer. Okay, save interest, get out of debt faster. Write it down. All right. So now, what if I have $4,571.12? I know I'm going to give that to the bank eventually, but do I have to give it to them in 12 monthly installments? Okay. Remember when I said for the person that had a little bit of money, and let's say they were able to save up some money. What if they could save up maybe $10,000? Could they take like $4,000 of it, $4,500 of it, and prepay this loan? Look what happens. If I prepay this loan, I'm paid down to line 12 in 1 month. I just took off 1 year worth of payments. I just took off 12 payments I never have to make. 12 payments I never have to make by giving the bank that money at one time. And look at the interest that I save. What happens to all the interest payments between line 2 and line 12? You skip all of those payments. You just saved right here. If you look it up, you just saved $28,754.57. So do it the bank's way. It costs you $31,355.20. So for everyone that thinks they don't have money to do this with, I guarantee you have the money. I guarantee you have the money, because to stay in this loan, to do it the bank's way, you're going to pay them $31,555.20 to give them $4,500 to pay down your mortgage in 1 year. That is a total of 34. That's like almost $35,000 paid out in 1 year. But what's the benefit you get? $4,571.12 in equity. That's what you get out of all that money. So what if I had that money in the bank? What if I prepaid it? I could be down here in 1 month, and my next mortgage payment for February would be on line 13 of my amortization schedule. Wow, look at that. $4,500. Now let's go to the 5% mortgage. Now remember, our principal payments, look how tiny they are. And people get distressed when they see that. But I'm going to show you, when you have tiny principal payments, you need to jump for joy. Watch this, because when I lower the payment to 5, when I lower the interest rate to 5%, my principal payments go from $368 and $371 to, look at this, $540 and $542. What? So you mean if I lower the interest rate, my principal payment gets larger. So for me to get rid of one payment now, I have to come up with $542.95 to get rid of one payment. Folks, is it harder to come up with $371 or $542? You tell me. If we lower the interest rate, did we just make it harder to pay the loan off cheaper and faster? Watch this. Watch this. Remember, if we take $4,500, we knock off 1 year's worth of payments. We knock off 1 year's worth of payments for $4,500. On the 7% loan, look what $4,500 does, somewhere between 8 and 9 payments. It only takes off between 8 and 9 payments, the same amount of money. So folks, who do you think understands this very well? By taking this money and applying it to the loan, you can knock off 12 payments at the 7% interest rate. You only knock off 8 or 9 at the 5% interest rate. If you think that's valuable, put a number 9 in the chat. I need to see some more number 9s in the chat. Okay? Whoo. Wow. Listen, folks, things are getting to the point where we need to learn how to live with what we have instead of complaining about it and sitting on the sidelines. Because if we see these high interest rates and we react the way that we've been taught to react to them, okay, then we're going to sit on the sidelines and not do anything and not take advantage of gaining equity. We're not going to take advantage of building up wealth for the future. We're not going to take advantage of actually owning a piece of property, okay? Because somebody says that the interest rates are too high. If you can't afford it, then take advantage of these interest rates where they are. You just have to learn the rules to the game. And folks, we're teaching you the rules to this game. All right. So now, if we can understand that, I need to show you the same loan. We're going to show you the same loan, $450,000. We're going to show you the same loan. We're going to duplicate this tab. You guessed it. What you all been waiting for. What happens at 10%? And I need somebody to come to the stage, please, and help me to explain this based on what you've learned. All right. Anybody can come to the stage, or somebody on the stage already can help me to I'm going to put it on here, and I need somebody to help me to understand this based on what you've learned today. I'm going to change the interest rate to 10%. Now, remember, we're assuming that the person with this loan can well afford it. If you can't afford it, I'm not talking to you. Okay. But if you can afford it, because interest rate, the experts are saying interest rates are going to go to double digits. Okay. So let's take a look at what happens. Okay. What happens if we go to 10% here? Look at the payment. At 10% interest, the payment is $3,949.07. It's probably not as high as you thought it would be. At 7%, let me show you at 7%, it's just under $3,000. At 10%, it's just under $4,000. So it's $1,000 more. So if you're making good money and you can afford this, it's just $1,000 more. I want to show you what happens. I'm going to show you how the payment is configured now. Let's scroll down to payment number 1. Let's look at this loan at the 10% interest rate. I need you to take a look at this. I need somebody to raise their hand, come to the stage, or somebody who is on the stage who's looking at this can help me to understand this loan and explain what's going on here. Is this if this was your loan, are you in a good position or not? Somebody tell me. Raise your hand. Come to the stage or put it in the chat. Okay. Look at this thing. Look at the teeny tiny principal payments. What did we learn early? Control the principal payment. You control the loan. Look at these principal payments. $199.07. The next one, $200.73. Wow. 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 How do you survive having 10% interest rates? Learning how to read an amortization schedule. Tiffany, what are you seeing here? Okay. What are you seeing with these tiny principal payments? What are you seeing? Okay. All right. So now look at this. Remember, we had we had at the 7% interest. Let me put this over here. 7% interest. Remember, at the end of 1 year, we could prepay $4,500. Look at there. At the end of 1 year, we could pay $4,500 at the 7%. All right. Now, remember, this is for people who can afford it. They've got some cash on the side. At $4,571 at 10%, $4,500 prepaid to this loan takes off almost 2 years. What in the world? Has anybody ever showed you this? How you can survive if you have to, when we go to double digits, and the experts are saying we're going to be there, are people still going to be buying houses? I just need to know, if we go to double digits, are people still going to be buying houses? Anybody on the stage? Anybody in the chat? Anybody who wants to come to the stage, raise your hand. Miss Tiffany says, I want to come up to the stage. All right. Invite to speak. Miss Tiffany, come on up. All right, Miss Tiffany, talk to us. Tell us what's on your mind.
Good morning, everybody. I'm calling. I'm in here from Dallas, Texas, and I am a mortgage loan officer here in Texas. So this just sitting in here, this I hadn't been in this industry maybe only 5-6 years now, and now I'm just by looking at this. After we did so many refinances and so many purchases over the last 2 years or so, it making me feel like, okay, we've really kind of been duped into these 2% rates, because I know that my amortization schedule is, just thinking of 299 versus a 8% loan. I'm feeling like really, there's no reason for us to, try to hold on to that extra low interest rate. Me personally, I'm concerned about, I want to take out a renovation loan, but I'm like, okay, if I want to refinance that right now, I'm going to be, far into a higher interest rate than what I currently have. And now just learning this, I'm not so much concerned about it anymore.
Ooh, Miss Tiffany. Ooh, Miss Tiffany. Isn't it good to know that? See, when you look at all the numbers, Miss Tiffany, when you look at all the numbers, okay? When you look at your after repair value, you're going to do some renovations on your house. Is your house going to be worth more?
Most definitely, yes.
Okay, it's going to be worth more. But the money you borrow, whether it is out from a line of credit, and I know Texas does home equity lines of credit differently.
Right.
You can only take out so much money at a time, right?
Right.
Okay. So whether you do a cash out refi or get a home equity line of credit, okay, it's going to be at a higher interest rate than you have right now. And most people would be reluctant to borrow money at a higher interest rate. They're going to sit back and do nothing. But I can improve my equity in my home if I borrow it, and then you control how much interest you actually pay on that loan. What do you think, Miss Tiffany?
I'm thinking I'm gonna hang around in the loan business for a little while longer, to help educate people and make sure that they understand this. This is a big deal.
Miss Tiffany, what's going to happen? What's going to happen to some people's loan business? What's going to happen to people in your industry when they hear over and over again, I don't want to buy at these rates? What are we going to do? What can you do now, okay, to help them to see the light?
Now I can properly educate them and really kind of show them the numbers, just as you've done here on the YouTube. Hey, 7% or whatever percentage it is that they have. I know I did a lot of refinances, getting people down to 2.5%, and now. Now that rates have crept up, that is a thing. A lot of people are like, no, I don't want to buy now. And what I'm seeing here in this market, even though the rates are at 6.5 to 7.5 right now, what I am seeing is that the housing prices, they are coming down here in the area.
Okay.
So I don't know. Hopefully that'll kind of help offset, the cost.
Well,
but
listen.
Yeah, most definitely. A lot of people are leaving the industry because they don't know this information.
Listen, you can hang around a little bit longer because you can, like you said, you can help educate your people and take advantage of the higher interest rate, because there's also going to be less competition amongst those people who can afford to buy a house at these rates and these prices. Not everybody can.
Right.
But are there still going to be people buying houses even at 10%?
Yes.
You better know it.
Our first home was at an 8%.
Who's going to be there to service them, Miss Tiffany?
I'll be here.
And you're going to be able to help them, because listen, what we're putting up here is going to be up forever. Huh? You can watch this over and over and over again. So, Miss Tiffany, can I take this a little bit deeper? Because somebody's going to say, well, Don, if I refinance this 2 years later to 5%, I'm going to owe less, right? I'm going to owe less. And I don't have to. Most of your refis are refining back to 30 years, aren't they?
Yes, they are refined back to 30 years.
Okay. But what if somebody says, well, listen, if I'm down 24 payments, why don't I just stay where I am? That's gotta help. I'm going to show you. Can I show you the numbers on if I'm at 7%, where my principal payment is, but we're going to pay it down and we're going to refinance this thing. We're going to refinance it right where we are. And I'm going to lower the interest rate. Let's see if we're still better off at the 7%. Would you like to see that?
I would love to see that.
All right. So here's where we do. So if I have this, I've got 7%. Okay. Let me pull this back over here, and let me pull this back over here. All right. So we have 5% and we got 7%. Let me put the 7% here. All right. So let's see, five. Let's see. All right, 7% loan. Boom. All right. So now we're paying this thing down like most people do. Okay. And I need people to see it, how most people do it. And in 24 months, that's 2 years from now, they're going to pay this loan down by $9,472.68. And they will have paid out $62,379.96. You know, Miss Tiffany, I think people, the average person refis every 5 to 7 years. Would you say that would is that what they're telling you in the industry?
Well, yes, they have. In my experience, I've ran into a lot of people who are still sitting on the same rate they had from 2007.
Okay. All right. So here's what we're looking at, folks. Let's take a look at 2 years in. Okay. Well, even better. Let's go to 5 years. I want to do 60 months. Let's do 60 months. Okay. And this is going to be scary. All right. If we pay this down, if somebody can afford this, they've paid the loan down by $26,407.74. And they paid out $153,000 in interest to get there. All right. I think it's important. I think it would be important to point out if somebody wanted to refi after 5 years to show how much interest they've already paid to this point. I think that would be good to do. Show them what's going on. All right. Now we're left with $423,592.26. So I'm going to set this up the best way I possibly can, Miss Tiffany, with no closing costs. What do you say to that?
Yeah, let's do it.
Okay. No closing costs on this thing. No closing costs. All right. So we're going to take how much we owe, $423,592.26 to the penny. All right. We're going to copy that. Now, what are my principal payments here at 60 months? My principal payment is $519.87. All right. $519.87. That's at 7%. So we're going to duplicate this tab. All right. So now I'm going to put in how much I owe into Brett Whistle. Do that. I got to take out that comma because Brett Whistle doesn't like commas. We're going to change this to 5%, no closing costs. And we had 360 payments. And we're going to subtract 60 payments. So we're going to end up with 300 payments. Okay. 300 payments. All right. Now, the experts are telling us don't refi back to 30 years. Stay where you are. Okay. So I'm down here at 423. I'm not charging any closing costs. Okay. Not charging any closing costs. We're going to take that out. And now here is our new payment. $24.76.28. Look at that. All right. That's my new payment. Now remember, my payment here, I'm down 60 months. My principal payment is $519. Look at my very first principal payment here on this loan. I haven't even looked at it yet. Look at my principal payment. Miss Tiffany, are you watching this online with me?
Yes, I am.
Okay, so there's a slight delay. So when it changes over, I need you to tell me what the new principal payment is. And we didn't charge a single dime in closing costs. And we kept the payment. We kept the number of payments at 300. What's my principal payment now?
Oh yeah, it's more than what I was just seeing here, unless it's a delay.
Yeah.
Let me see here. Looks like we're in the 700s.
Yes.
As far as the principal payment is concerned.
We lowered the interest rate. We with no closing costs.
Right.
And now to get rid of one line on this amortization schedule cost me $714 now,
Yeah.
as opposed to where I was, it was $519. Wow.
Yeah.
Now,
Sir, I feel ripped off.
let me show you something else that's happening, okay? I'll show you something else new. All right, we're going to change this now. We're going to change this to adding a closing cost of about what? I've seen between 8 and 10,000. I've actually seen people pay more. So are you seeing that in the industry? People pay between 8 and 10,000 for their refinance.
Yes, I am seeing that.
All right, so let me make this easy. Let's change this to 400 and 400, and instead of 423,000, it would be 433,000 if we rolled in the $10,000, correct?
Yes.
Okay. At 5% interest, my payment is still lower. It's at 2534, as opposed to my payment was 2625. So now I've got a lower payment of 2534, and I've rolled in the closing costs. So to get back to where I was before I refined, okay, to get back down to 423,000, I have to pay back the $10,000 first, don't I?
Yeah.
Okay. Let's see how we paid back that first 10,000. Okay. So in 1 year, it's going to take a little bit for you to see this on one side, but in 1 year, cumulative principal, I've paid back $8,940.31. I haven't even paid off the whole $10,000 of the closing fee that I rolled into the loan, have I, Miss Tiffany?
This looks really good.
Okay. All right. And how much interest have I paid on just $8,940 of the $10,000 I rolled in? How much interest have I paid on that already?
About 1,700, almost 1,800.
Now I need to took a cumulative interest, a column 4.
Oh wow. Okay, $21,000.
So I listen. I got a lower interest rate. I stayed at 300 payments, right? And I rolled in my $10,000, and I'm trying to pay that back first, but I've only paid $8,900 of it, and I've already paid $21,000 in interest. So by the time I paid back my $10,000, I'm on line 14, aren't I?
Wow.
Of my amortization. Okay. I finally paid off my $10,000 that I rolled in here. How much interest did I pay on a $10,000 loan? Look immediately to the right on line 14.
Okay, let's see on line 14. Well, 10 grand. Yep, 10,474 and 22 cents.
That is the principal, but how much interest did I pay on it? Look immediately to the right.
1,766.
No, that's to the left.
Okay, to the $25,000.
Exactly. Listen, I know you didn't want to say that because you said that can't be right. Did you mean somebody with perfect credit just lowered their interest rate by 2 points, stayed at 300 payments, didn't even go back to 30 years, stayed right where they are, all right? And to pay back the first $10,000 that they rolled in, that the bank is actually going to charge them 25 grand on their to borrow that money. So the refinance actually costs what? $35,000. Miss Tiffany, is that what's going on here?
I have some studying to do. I need to study this here, but yes, this is mind-blowing.
So watch this over and over again. So folks, I need you to share this out to everybody. And listen, I'm going to take a quick break here. I got to get a drink of water. And so what we're going to do is have somebody who is also taking advantage of this information. They've seen it. They took advantage of it. And now they want to do something that's great. His name is Dr. Eric Thomas. E.T., the hip hop preacher, saw the P.I.L.L method, took advantage of it, and said, I want to make things better for my wife. Let's listen to what E.T. has to say about the P.I.L.L method. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L method. I invite you to watch and listen.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to pillmethod.com and request a savings and earnings report today. All right, folks. Listen, if you want to know more about what we're doing, we have what's called an opportunity cost calculator. I know we've been throwing a lot of numbers at you. And this is how can a person look at all of this and do it myself? We don't expect you to. I'm just giving you some background information here and showing you that there's more to what we've been to borrowing money than what we've been told. What the math is not all that hard. It's just so much of it to sit down and say, am I going to be better at the 5%? Am I going to be better at the 7%? Am I going to be okay at 10%? And should I refi when this happens? Or should I stay at 300 payments? Should I go to 30 years? Should I get a 15-year mortgage? All of those things enter into what's happening. You want somebody who understands, you want a company that understands this from the bottom up, okay? And we have the technology that handles all of this. How would you like to have something that would be tantamount to having a GPS for your money? I mean, telling you how much money to move, what month to move it in, what day of the month to move it on, and how much money you want to keep in savings for those people who don't want to. So it's important to keep some cash stashed back. Okay, we can do all of that. You can grow your savings, have cash available for emergencies. Number one. Number two, you can save money on interest, cut your interest costs by 75%. Number three, still pay off all of your loans, not just your mortgage, but your mortgage, your student loans, your credit cards, everything, and your auto loans in about 7 to 9 years. You can do all of those things with the P.I.L.L method. If you want to know the month, day, and year you can be debt free, then go to my link up above. Find where it says get a savings and earnings report. Follow all of the instructions. Fill out the information. And then someone from my staff will give you a call and set up a consultation for you. And you can know the month, the day, and the year you will be debt free and how much interest you could save. If you're worried about the 7% interest rates, if you're worried about these higher interest rates, and you are in a unique position to continue to purchase, we're going to show you how to make the best out of those higher interest rates. In fact, I'm going to be meeting with another loan officer probably next week to show them that this idea of marrying the house and dating the rate And when interest rates drop, automatically assume you're going to be in the best position financially when you refinance. I'm hoping to educate an entire generation of real estate agents and loan officers that you have to do the numbers to see whether a person is going to be benefit from refinancing or not. I would never say refinancing is never good. What I am saying, do the math and find out if it's good for you. The math will tell the story. But if the math ain't mathing, don't go down that road. All right, folks, listen, I also have the only book on Amazon out of 33 million titles that talks about what we're talking about today, how to understand an amortization schedule and how we need a computer system to do all of this for us so that you're not stuck trying to do it yourself and still pay more interest than you need to. My book gives you the background information so that you can understand it better. Go to Amazon and get that book. Get it today. It's great for Christmas gifts. Start purchasing your Christmas gifts now. What could be a better gift than to give your grown son or daughter, nieces and nephews, or grandparents to give a book to your kids? So listen, and give it to your grandchildren. Listen, what better gift than to give them financial freedom and security and financial education that actually works? Get the books now and give them out as gifts for Christmas, for Thanksgiving. Have it ready there at on your coffee table at Thanksgiving. When people show up and says, what is this book? Talking about how to get out of debt, the better way to get out of debt. And then you could say, listen, this guy talks about how to get out of debt in 7 to 9 years. And you don't need more money. You just need to understand how the bank does what they do. And then cut your interest cost by 75%. Everybody makes money. Don, why are you worried? Why are you not worried about the fact that the bank has these loans paid off? I'll tell you why. Because every time you refinance, do you realize the bank that you're working with has to pay off the old loan anyway? They do it every 5 to 7 years. It's part of what they do. Okay. So now, if you're saving all of that interest, where are you going to keep it? In your mattress? Or are you still going to put your money in the bank? Are you still going to spend it into the economy somehow? Are you still going to invest that money? The banks still win when you save money. That's why I don't have any problems. Everybody makes money. But this way, you can make money too. All right. Listen, anybody on the stage have anything to input? Miss Tiffany.
I have quickly, Don.
Yes.
I have Jay Hatchie in the chat saying, "Will you please put formula in chat?" But then she'd have to go to the other platforms to get that.
Okay.
And CM Henderson is saying, "We have been sold a lie. We need to renew our minds for our sake, our family, and the next generation."
That is so true. Folks, get the book. Get the book. Get the book today and share it with individuals. Buy multiple copies and give them out as gifts. You will not be sorry. All right. So, Donna, what was that somebody wanted me to put on? What were they saying?
The formula in the chat.
What formula?
I'm guessing the formula that's on the like how you do the YouTube, but it would not be very possible because those you'd have to watch live. You can't do
Okay.
live on the
So listen,
chat
if
here.
they're talking about the formula that the bank uses to amortize loans, okay, you can just Google that. What is the amortization formula? My formula is copyrighted. It is that is under our we own what is that called? Because you've got copyright, we have that, and it's a registered as a trademark. So we can't give that out. But if you want to know more about what we do, you can go to YouTube and click on and put in there our YouTube channel and search Opportunity Cost Calculator. Opportunity Cost Calculator, and a video will come up that you can see. It's 23 minutes long. It's not very long, and you can actually see a demonstration of our program, which is unlike anything else on the planet. It is the only program on the planet that saves you interest, that can save you the maximum amount of interest mathematically than any other program on the planet. No one anywhere in the world saves you more money than the P.I.L.L method. I want you to know. Thank you, Jeremiah. She says, I think intellectual property is what you're trying to say. Thank you so much. Listen, I love it when people just step in to help. Oh my goodness. Listen, folks, if you got good information today, put a number 9 in the chat, because we've been here. It's the fastest 2 hours on Clubhouse. We've been here for 2 hours. I need you to do 2 things for me. Well, actually, maybe 3. All right. Put number 9 in the chat if this has been valuable to you, that you don't have to be afraid of 10% loans. If you can afford it, you can turn a 10% mortgage on its head, because you will control the principal payment, and interest payments you skip don't matter. And what we're also doing is controlling our interest cost by using our dormant money that may be sitting in the bank. If you want to know how to do all of this, okay, if you want to understand more about this, watch the videos. But if you want an expert to take over everything, so that and you can use a system that is a lifetime system that will be with you and your family for the rest of your life, to do the math for you, to guide you like financial GPS. Do this on this day with this much money, and will help you to create a large savings account for emergencies, help you to get out of debt in 7 to 9 years, and get into real estate investing, so that you can own more property, you can own it faster, and you can own it cheaper, because we're going to learn how to use the bank's money at a discount. Everything, we have all of that for you. Why try to figure it out for yourself when we've already done it? Folks, I want to thank you so much for being here. And I want to let the folks go online for a little bit, and then we're going to come right back here to Clubhouse, so everybody can, so the moderators can say goodbye to you. And listen to this, folks. We're going to be back here. On Friday, but on Sunday, Credit Goddess is going to take over the show. You want to know more about getting your credit in shape? Oh, you want to talk about your credit profile versus your credit score, how to level up your business credit. You want to be here on Sunday to listen to Credit Goddess talk about that. So, folks, I'm going to say goodbye to everybody online. We'll see you back here on Wednesday at 7 a.m. Central, at 8 a.m. Eastern. We're going to give Dr. Eric Thomas the final word. See you all on Friday. My name is Don Daniel, founder of P.I.L.L Method International, and our team created the most powerful money management, wealth building, debt elimination system ever created. At our recent seminar in Nashville, Tennessee, the keynote speech was delivered by the #1 motivational speaker in the world, Dr. Eric Thomas. E.T., as he's also known, mentioned he paid off his mortgage in 4 years using the P.I.L.L Method. I invite you to watch and listen.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
Did you hear that? No mortgage, no stress. If you would like to become debt and mortgage free within an average of 7 to 9 years by cutting your interest costs by up to 75%, go to PILLmethod.com and request a savings and earnings report today.